Good afternoon, everybody. I see the numbers are building now coming into our webinar, so I might kick it off. On behalf of all the partners and staff of KPMG, I'd like to welcome you to this, our fourth webinar in our Lunch and Learn series. My name is Ken Hardy, and I established and lead the R&D incentives practice. This afternoon, I'm joined by my co-presenter and partner in the incentives group, Damien Flanagan. Our presentation, including Q&A, will run for about 45 minutes this afternoon. And if during that presentation you have any questions or queries, please feel free to submit that question through the chat function, and we'll pick it up at the end of the presentation. Our agenda today includes an overview of the current landscape state of play with the credit, which I'll deliver. Damien will then bring us through maximising cash flows, grant support, making efficient claims, the documentation test, and I'll talk a little bit about the most recent July 2020 guidelines and, of course, the impact of COVID-19 in this space. So by way of background, for those of you who aren't overly familiar with the credit, it was introduced in 2004, so it's been with us quite a long time. It's a 25% credit for every one for expenditure that you incur on eligible activity. So for every 100 euros spent, you receive a credit of 25 euros. That expenditure must be incurred by a company wholly and exclusively in the carrying on of R&D activities, and that's an area that the revenue concentrate a lot on. The credit is available as a tax credit in the first instance or as a cash refund, subject to limitations. So it is a very valuable relief, either in reducing the amount of tax you have to pay, or if you don't have the tax capacity, as a cash refund issued by the revenue by reference to your payroll liabilities. Other aspects of the credit claimed on a group basis. So again, depending on the nature of your organization, you can elect to move credits in between different companies subject to reasonably complex arrangements. Your expenditure must be net of any grants that you've received from the state, the EU, or the EEA, and the revenue have tightened that up in recent years. So only the expenditure, the net expenditure you incur, is creditable. The activities have to be undertaken in the EEA, so that's basically the EU countries, Norway, Liechtenstein, Iceland, and some other countries. However, it's the company's employees itself that must carry on the activity, and the company itself must be within the charge to Irish tax. Final test, the qualifying expenditure that you seek to claim your credit on cannot be available for a tax deduction under the law of another territory. So that's the background to the credits. If you were to think about the incentives landscape in Ireland as a pyramid, it would be fair to say that the R&D tax credits are the fundamental part of that landscape. They're the foundation of the pyramid, if you will. It is the single biggest area that the government provides supports in. After that, it's the direct grant awards from the Enterprise Ireland, from IDA, from Science Foundation Ireland. On top of that, then in the pyramid, the EU grants program, the Horizon 2020, the framework programs, and then the KDB, which you may have heard an amount about, but which is only getting off the ground now. So that's the pyramid of the reliefs, but the credit being the significant part of the incentives landscape. So this is the number of credit claims in the pink-purple line. You'll see the number of claims that have been made since the credit's inception in 2004. So it started off at 73, and you'll see it ramped up over a number of years and plateaued around the 1,500 claims per annum, with a tail off in 2018 to 1,300, and I'll talk a little bit about that in the next slide in a moment. What you'll see in the grey columns is the cost of the credit to the exchequer. So back in 2012, 282 million, ramping up in 2015 to 708 million, and dropping off quite significantly 16, 17, 18 down to 670, 448, and the most recent figures we have 355 million. And you might wonder why that is. You can see that the number of claims is reasonably stable around the 1,500, but a significant rise, if you will, in 2015, 2016 in the cost of the credit, and it dropping back to a more normalized number perhaps in 17, 18. The department or the revenue haven't provided any explanation, but our supposition is that in the 2015 and 2016 years in particular, we expect that there were significant capital expenditure claims from the pharmaceutical and biotech sector that had their credits claimed. And the generous relief that we have here, the generous regime we have here, allows you to claim your credit on capital up front in one lump. And we suspect some large facilities came online in 15 and 16 that led to that spike in the cost of the credit. There's also a possibility that it might be around some governmental accounting rules as to the refundable credit and how they book that and how they provide for that might have also contributed. But as I say, the department or the revenue haven't ever explained why it is, but that is our expectation. Moving on, the breakdown of the credit provided here in the two pie charts. On the left-hand side, the number of claimants or the percentage of claimants by reference to the number of employees they have. And you'll see there's three big cohorts, if you will. The 250 plus the large companies only accounting for 11%, and then we're into the 50 to 250, the 10 to 50, and the less than 10 accounting for almost 90% of claims. But if you look at the pie chart on the right, you'll see that 64% of the cost of credits is accounted for by 11% of those claimants. And that's really saying to us, it's the large multinationals, and this isn't surprising, but the large multinationals are claiming 64%, or the large companies with large number of employees who tend to be the multinationals, claiming 64% of the total credits awarded in any period, with the lesser percents by the smaller companies. And that's not surprising, given this credit is driven by the number of employees and salaries and materials and capital investment. It's not surprising that the larger companies claim larger amounts. Our next slide provides an analysis, if you will, and this is provided by the Department of Finance, as to the different sectors and the number of claimants in that sector. Now, the definition of what types of businesses are included in these sectors is not available. But what you will see is that under the manufacturing sector, 400 claims, the ICT sector, 400 odd claims, and professional, scientific, and technical advisors, about 200 claims. So the lion's share of claims, either through scientific and technical activities, ICT, or manufacturing. What surprises me in this one is the amount of credit claimed in wholesale and retail trade. I wouldn't expect R&D activities to be taking place in those sectors, yet 125 claimants in 2018 were in wholesale and retail trade. But it's indicative, I suppose, manufacturing, engineering, pharmaceutical, biotech accounting for a good chunk, ICT accounting for another good chunk, and then scientific and technical activities really for the balance. My final slide before I hand over to Damien is around the number of revenue interventions. And what you'll have seen from 2012 forward, there's been a significant increase in the number of revenue interventions. And those interventions could be formal, full on-site audits, they could be desk audits, they could be aspect query letters, but they tend to be invasive interventions by the revenue where a number of detailed questions are asked of R&D tax credit claimants. And you'll see that pink-purple line rising in 2016, 276 interventions, and we expect, although the number hasn't been published for subsequent years, we expect that number is rising. What you'll also see in the bar chart is the yield, or the amount of settlements arrived at as a result of those revenue interventions. So 2013, about 14.5 million taken back from people who had claimed, or companies who had claimed credits. But a significant yield nonetheless, you'll see in each period that we have statistics for. And what that says to me is I expect that we're going to see an increase in revenue interventions for recent claims. The cost, the exchequer of this credit, and indeed the COVID-19 crisis we find ourselves in, is going to lead to an increase in the number of interventions, and an increase in interventions is likely to lead to an increase in yield. And that's certainly what we saw after the global financial crisis. Credits got a lot of attention because they are subjective and they are expensive, and it's something that I expect we're going to see in the future. At that, I'll hand over to Damien, and I'll join you later in the webinar.
Thank you, Ken. Good afternoon, everyone. I'm going to talk a little bit this afternoon about maximizing cash flow. Cash flow at the moment is important for everybody, perhaps more so than ever. On April Fool's Day, the Revenue published an e-brief, and I suppose thankfully it was no April Fool. What this e-brief said was that Revenue will pay out any cash installments or cash refunds that your company is expecting to fall due in 2020, and that they would pay them out upon receipt of an early corporation tax return filing. So for companies that have a December year end, that meant that those companies could get the second installment of 2018, the third installment of 2017, along with the first installment of their 2019 R&D tax credit claims, paid to them almost as soon as they submit the corporation tax return, which, as you'll know, is normally due to be submitted on the 23rd of September. So we're at that point now, almost 3 weeks away. So the debrief for companies that have a December year end, it's obviously less important that the time has passed. But for companies that have a January, February, or March year end, and that will be filing their tax returns between now and December, there still is an opportunity to file your tax return early and get the refund of installments a little bit quicker from Revenue. We have seen Revenue pay these out. We've also seen them being held up as well, a little bit infuriatingly. But safe to say that if you do have March year end, February year ends, let's get that corporation tax return filed a little bit early, and you can get those refunds processed. For companies that have excess R&D tax credits over and above their corporation tax liability, what I've got on the slide here is just an example of how those excess credits are normally refunded. Firstly, you'll offset the R&D tax credit against any corporation tax that you do have in the current year. If you have excess credits at that point, you carry back to your prior year. So for 2019, tax return has been filed now. If you have excess credits, you carry back to 2018. And if you have excess credits still at that point, then you fall into the refundable mechanism. This might be more relevant for companies in 2020 when their corporation tax liabilities may be significantly reduced over and above what they expected, what they had paid large corporate tax in 2019. So do remember when we get here this time next year, and when you're filing your R&D tax credit claims, that it is possible to carry back any excess credits and offset against the prior year tax liability. Some companies do have excess tax even after utilizing the R&D tax credits. And I guess the important thing to remember from this slide is the order of the offsets to ensure that you maximize your tax offsets. So again, as always, your current year tax credit is offset against your current year corporate tax liability. If we still have tax to pay, then we can look at credits carry forward. And the first place you would go is to any non-refundable tax credits, which for those that have them, are any credits that arose pre-2009. So you would use those first because you can't get them paid out. So those non-refundable, use those. Then you would use any refundable tax credits that you carried forward from, say, 2017, 2018, 2019. And would use those to offset against your tax. And then if you still have excess credits at that stage, then you're into the cash refund mechanism. The important thing in this slide is just those non-refundable tax credits. There was a new regime introduced in last year's budget. So last October, it was announced that the rate of tax credit for small and micro companies would increase from 25% to 30% for qualifying expenditure. It was also announced that the limit applying to the cash refundable amount would be twice the payroll tax liabilities and not just once the payroll liabilities, which it was previously. And also for companies that are pre-trading, it's now possible to get the R&D tax credit for those pre-trading activities before you even commence trading. So some important improvements. We are still waiting on state aid approval for these updates, so they're not live yet, unfortunately. And the other thing to remember is that it applies to small and micro-sized companies, so that's companies that employ less than 50 people and have a turnover or balance sheet of less than 10 million. But going forward, we expect these improvements will be implemented and they will be very important. We're seeing quite an uptick in companies looking for grant support from the likes of Enterprise Ireland or the IDA. As Ken mentioned earlier in the pyramid, there are different types of grants that are available. Within the national programme, IDA, they can fund up to 15 million euros for R&D projects, so a very significant investment. And since the COVID lockdown started back in March, we've actually been working with a number of large multinationals who are claiming significant grants in the many millions. And I'm certainly feeling that the appetite is there from the IDA to invest in R&D programs. There are other grants available from the IDA that are not necessarily tied to R&D, such as training and capital investment grants. And Enterprise Ireland also provide support. They have what they call the large R&D fund, and you can get up to 650,000 euros in that program. And they also have other programs where they take an equity stake in smaller companies. So these are things to bear in mind, particularly where you continue to innovate, continue to invest in R&D activity. The IDA and Enterprise Ireland are certainly open for business. There are also EU grants, Horizon 2020, the LIFE programme, European Innovation Council. And these are all good places to look where you are involved in R&D programs. There can be quite a bit of work involved, and kind of on the back of that, we've set up recently our grants practice, where we're working with companies to help them draft their applications for the relevant supports, as well as looking at pre-existing grants and assisting companies in applying for the grant drawdown, which is the receipt of funds. And where we're also working with companies, assisting them with their R&D tax credit claims, there are efficiencies in doing the R&D tax credit lines at the one time. You're really looking at the same data for two different purposes. So do bear that in mind if you do have grants that you need to draw down. We've also worked with a number of companies who were looking for grants for specific COVID-related activities. We worked with them to discuss calls for funding with Science Foundation Ireland and the IDA. And as I said before, we're finding that these authorities are willing to listen and have been willing to listen over the last 6 months, particularly in relation to COVID grants, which might be particularly relevant to med device and pharma companies at the moment. Making efficient claims is something that is of interest to everybody. The service lines that we offer, they're complementary, I think, and I suppose it is important to kind of realize that All of these four areas on the screen, they do feed into one another, allowing you either to maximize your claims or to make efficient claims. You know, the R&D grant process will feed into your R&D tax credits. Your R&D tax credits will feed into your knowledge development box claim if you're going to make one. And also capital allowances is part of all of this as well. As you may know, it is possible to get R&D tax credits on capital expenditure, but only where that capital expenditure qualifies for either wear and tear allowances, also known as capital allowances, or industrial buildings allowances. So it's important to maximize your wear and tear allowance claims or your IBA claims, as it then follows that your R&D claims can be maximized where you're using that capital for R&D activity. An example that we often look at is where a company may do a fit out of an R&D space, and they may capitalize all of that expenditure and include it as buildings expenditure in the financial statements, and not actually look to segregate the plant and machinery from the building expenditure. So by doing that exercise and by maximizing your capital expenditure claims from a wear and tear allowances and industrial buildings allowances perspective, then that can increase your tax credit claim. So just a point to note on this slide that these services do work together, and whoever you work with, you should try and look at these holistically. A lot of our clients are moving to what we call a real-time process for preparing R&D tax credit claims. A little bit of a history lesson. When the R&D tax credit was introduced in 2004, companies obviously hadn't made claims before, and there was a challenge to gather the information, the supporting documentation to understand what R&D was and how to file a claim. So that heavy lift back in 2004 probably existed through to 2009, because up to 2009 companies could look back 4 years and bundle 4 years of claims all together in one claim. And that was quite a bit of work, quite a lot of looking back. From 2009 forward, then companies were given only 12 months to file the claim. So that shortened the time window to look back, but it still meant that you could be filing your tax credit claim in December 2020 for activity that you did in January 2019. So you have an almost 2-year window to look back and to try and remember what you did and to look at what costs you incurred. And that process can be burdensome, particularly on the engineers and scientists who have to write the R&D reports that go to revenue. From a financial perspective, it's probably a little bit easier to track those costs, but certainly engineers and scientists have found it particularly burdensome looking back that far. And certain sectors, notably in software, probably are even more challenged in that regard. As the process became more mature, companies have started to incorporate the information that revenue will require into their R&D project management, into their timekeeping and financial systems, so that the R&D tax credit falls out of bed that little bit easier. It's still a requirement to write the technical reports, so we still find that engineers are having to look back a period of time to what they did and to try and get back into that space of why it was technically challenging at the time that they were doing it. On the back of this, then the real-time process has arisen, and what this involves is working with companies as they are doing the R&D activity. So we would meet with our clients 3 or 4 times during the year, maybe on a quarterly basis or every 4 months, and we would work with the scientists and engineers to keep progress reports, to keep live progress reports as the R&D activity is happening. We would then take those progress reports at year end and amalgamate them into one overarching claim. This ensures that the scientists and engineers don't have to dig back into the memory bank, and that the information is captured as it's happening, which makes it more robust, allows you to pick up things real time that you may not otherwise, and to ensure that any gaps in documentation are plugged as and when they arise. There may be some first-time claimants on this webinar, and a couple of things to say is that we do work with first-time claimants, including large and small, across all sectors. Companies that have December year ends, you have plenty of time now, between now and the end of December 2020, to prepare and file a claim for anything that you did in 2019. You may worry that you mightn't have sufficient documentation to substantiate a claim. What we find is that most companies do keep a record of expenditure and activity. It might not be in the format that revenue would like to see, but we can work with you on that so that future claims are better positioned. We'll be able to quickly determine, based on a quick chat or meeting, whether or not you are in a position to claim, so no one's time is wasted. And we have a rapid assessment tool that is designed to help identify your R&D projects and estimate any potential benefits. So if you are a first-time claimant, do reach out and we can have a chat and either advance or kill the project quite quickly. Efficiencies is what everybody is after, and particularly with the COVID environment and what that has meant for companies, we're seeing obviously many employees working remotely, and that has meant that we can fit the technical interviews with your scientists and engineers into their schedule quite easily. So we don't need to block book days and sessions with your engineers. We can drop in, drop out to fit them. We can undertake the heavy lift where companies are looking to get back to business quickly, or where companies are resource constrained. And the heavy lift means that we will take on the majority of the burden of writing the technical reports in conjunction with your scientists and engineers, and present those in a way that they are fit for submission to revenue. We're able to turn around claims quite quickly. We have a big team, so if you have a window of opportunity, let us know and we can work with you quickly to get the claims prepared. And importantly, we can work with you peer-to-peer. Our team includes PhD microbiology, PhD chemistry, we have MSc computing, computer science, mechanical engineers, chemical engineers, electrical engineers, quantity surveyors. So we have a broad and experienced team, which means that we can pitch our guys with your scientists and engineers. They can speak the same language, which does enable a very efficient process. So just to summarize the key features of the practice, I've talked about the heavy lift that we can do. We do have unrivaled audit experience where we've dealt with revenue on hundreds of inquiries and audits at this stage. We know what's acceptable and what's not. We have appropriate experts on the team, as I've showed in the last slide, who can work with you on a real-time basis. One thing that we've started to do recently is help companies establish an R&D board internally to ensure appropriate governance over the tax credit. The tax credit can be quite substantial in monetary terms for companies, and it does need to, I suppose, be given that governance to ensure that any claims that have been filed and any processes that are in place are set up appropriately. And we have an R&D incentives toolbox, which includes webinars on how to complete technical submissions, best practice guidance, and so on, that we share with our clients. I'm going to talk a little bit about documentation. Not to go on too much, but I think it's important before I hand over to Ken, just to note that documentation has been a key focus of revenue in a number of recent audits and inquiries that we have had. And we would recommend that companies consider the documentation processes that they have, and also how maybe impact, or how COVID has impacted on any protocols or procedures that they have had in place previously. Appendix 3 in the revenue guidelines includes what revenue call a suggested file layout. So this is how revenue would like to see R&D tax credit claims. There are 24 questions with a number of subparts, adding up to 20 or to 37 individual questions. This is only suggested, and revenue do say at the top of this that it is suggested. So you're not bound by this, but certainly revenue will have an expectation that a lot of this information will be available. On the back of that, what we would recommend as best practice is that anyone involved in preparing and submitting tax credit claims should understand what qualifying R&D is and what qualifying expenses are, and understand the requirements for documenting and retaining evidence of these so that you can show revenue under audit or inquiry what you have. We would suggest that you document as much as is feasible, and different industries will have different standards. Try and organize the evidence so that it is readily accessible in the event of an audit. That audit or inquiry could come in 2 or 3 years' time. So trying to retain that evidence in a suitable location where you can easily put your hand on it is key, and will make any audit go a lot smoother. I've recent experience of companies that have had to invest significant time and resource trying to collate the information in a way that is presentable to revenue. And if they had done it at the time, it would have made life that much easier. You should protect against staff departures, so people will move on. If you have key man risk, do be mindful of that. Putting all your eggs into one basket could leave you exposed if certain individuals leave. So again, gathering that information at the time you're doing the R&D activity and before your claim is filed will protect against this. Prepare your claim on the basis of available evidence. Identify what gaps exist and make a plan on what to do better in the future. You should challenge your thinking, challenge the thinking of your scientists and engineers. Are we happy that the activities in the claim will stand up to revenue challenge, and ensure that all positions taken can be supported. We have a number of documentation tools that we share with our clients. We have what we call, and everything in KPMG begins with K, but we have our K-Doc suite of documentation tools that allows you to plan, monitor progress, and to track the resources utilized during R&D activities. So this will allow you to reduce the time and effort that you spend preparing a claim, and also ensure that you're best positioned for those revenue inquiries. And we do have a particular suite of documentation tools called KSoft for software companies. Just to close out, in relation to documentation, one of the things that we're often asked to do is to review the documentation that a company retains, and we almost undertake like an independent review where we would appoint one of our team members who hasn't been directly involved in the preparation of the claim to work with the company and to review what documentation does exist. So they will meet with the scientists and engineers, pick a project and sample that project to look at what documentation is available. We'll prepare a report then with a gap analysis between what documentation exists and what the revenue would expect, and we'll make recommendations on how these gaps should be closed. This provides visibility to decision makers as to the strengths and weaknesses of any claim, and it also provides a link between revenue's generic request for evidence and the specific documents that you do retain. So we have found it quite useful, and for companies that have done it and then have been subject to audit, they find that it's a much smoother process. With that, I'm going to pass back to Ken, and he will talk about a recent update in the July 2020 guidelines.
Thanks, Damien. And just a reminder to everyone on the bottom ribbon of your Zoom call, there's the Q&A function there. If you have any questions on anything that Damien has said or that I've said, feel free. And thank you to those who have already asked the questions. We will address them shortly. So as Damien said, there has been an update in revenue guidelines updated on the 1st of July 2020. And the details of that are on the next slide. And what the revenue announced, and it came as a surprise to us, there was no discussion with any of the advisors in this space. And usually, and heretofore, the revenue had been good at having a conversation or a discussion with advisors and players in this space so as to ensure that the guidance that was issued was appropriate and dealt with any concerns or issues that might arise. In this case, the guidance was issued on the 1st of July without any consultation or discussion with us or with the working group that KPMG helped establish with the revenue. This came out of the blue, and it wasn't a welcome surprise. But along with a number of minor tweaks, particularly in the examples that are called out in the 50 or 60 pages of guidance in the document, they were minor in nature and more clarifying accepted positions. But one thing that was new and was unexpected is the exclusion of rent as an overhead cost. And the guidelines now state that in the revenues view, rent is expenditure on a building or structure and is excluded from being expenditure on research and development by section 7661 of the Act. And that's the primary section that calls out eligible expenditure. Most of our clients, with our advice, and indeed most claimants, indeed all claimants, would typically claim an apportionment of rent and heretofore. So we're quite surprised by this insertion. The revenue would have seen rent claimed over the last 16 years in hundreds and hundreds of submissions under audit and never had an issue with it. Damien and I have made a detailed 8-page technical submission to the revenue on this point because simply said, we don't see a basis in law for this position. Rent, in our view, is not expenditure on a building or structure. It's related to, for sure, but it is not, as the law says, expenditure on a building or structure. So we can't see the basis in law for this. There's a TALC meeting on Thursday of this week, and that's a committee of senior revenue officials and tax advisors that come together to iron out issues that arise either in guidance or in legislation. So I would suggest to you it's something to watch. This is an expensive exclusion that the revenue have adopted. We don't believe it's based in law, and we'll have to see where that ends up. But it's certainly the stated position of revenue at the moment. Moving on to talk about COVID and to briefly talk about COVID. I suppose the first thing to say, and this slide says it in a number of different ways, but the net point, the R&D tax credit is a valuable relief, as I said at the beginning. You can account for it above the line. So it's a reduction in your cost of doing business in Ireland. It's an above the line treatment, not below the line on the tax line. A lot of our clients account for it that way, and a lot of our clients account for it on a monthly or quarterly basis, real time as they go, so they get the maximum benefit out of the credit claims. Say for 2020, they'll be taking their provision above the line on a monthly or quarterly basis as we go through 2020. That is often done by reference to prior year credits, and given the impact that COVID has had on multinationals and SMEs alike, we would suggest it's important that you ground your provisions in fact, and you look at the actual implications of what's happened in lockdown and since lockdown to your business. And what we're seeing on the next slide, the way that COVID and the lockdown has impacted a number of our clients is around staff emoluments through furlough, through the subsidy scheme, through redundancies. So this year's staff emoluments are different to last year's staff emoluments. So to take a straight line from last year could be exposing you to over-providing for the credit. But equally, technical issues are arising now around plant and machinery utilization. So if you have significant capital credits claimed in the past, you claim them on an understanding of the activities that you would have undertaken in 2020. Those activities perhaps have been reduced because of lockdown and furlough and other related matters. So are your plant machinery apportionments correct due to fallow time? In the same way, or indeed building utilization is based, you claim it up front, but on a basis of a continuous use over a number of years. Has the lockdown and subsequent activities reduced? And if so, what has that done to that 35% usage test? It's a threshold test. If you're beneath 35%, then you're in a restatement situation. So again, just something to be conscious of. But it's not just about that, it's also around materials and consumables. And you may have bought materials expecting to use them in Q2, Q3. What happens if their shelf life is now expired and you can't use them? They were bought for R&D, you plan to use them in R&D, but you didn't actually use them in the carrying on of R&D, and what's the appropriate technical treatment. These are issues that no doubt we're going to see play out when the 2020 claims are made. Similarly, R&D overheads and other costs, they're done on an apportioned basis, and the basis of those apportionments are going to be impacted by the slowdown due to COVID. Equally, health and safety related costs, PPE, health and safety officers and COVID officers, increased costs to the standard way of doing your business and the standard way of doing R&D. How should you treat those costs? Again, not called out in guidance, not dealt with explicitly in legislation, but certainly things that Damien and I and the team have considered. So at that, I might, we still have about 4 minutes left, and I'm going to go to Q&A. And I might deal with the first question, Damien, and you can take the second, and we'll do it that way perhaps. So first question, are there any plans to fast track the 2021 claim like they have for 2020, or be able to claim tranches that have already been approved? So Damien brought us through that accelerated refund mechanism that the e-brief on 1 April introduced. We don't know is the answer to that question yet. It is, I would expect it's something that the revenue will consider when they see how many fast track claims they actually facilitated or that they were able to facilitate, given the mechanism that had to be gone through to avail of it. But there has been no discussion, but it is certainly something that's on the cards. We actively engage with the department and with revenue on a weekly stroke monthly basis, and it's no doubt it'll be one of those things that we'll ask. Damien? Yeah,
second question. What is revenue's position on R&D carried on by an employee who has, due to COVID, been required to carry on their activities in a non-EEA country due to travel restrictions, where they would normally be resident in Ireland or the EEA? So for R&D tax credits, where a company is carrying out R&D through its employees, that R&D has to be done within the EEA. You're allowed to subcontract R&D activity to anywhere in the world, but where it's the company's employees, they have to be based in the EEA. Laura, to answer the question, it's not something that revenue have opined on yet. Similarly to what Ken said above, it is on a long list of topics that we are in discussions with revenue on. So we would hope to see some clarity on this, certainly towards the back end of this year in time for 2020 claims. But as yet, revenue haven't given a view. The strict legislative position is that those costs wouldn't be claimable as the person is not in the EEA. But like lots of things, COVID has upset the apple cart. So we'll wait and see on that one.
Thanks, Damien. I might take the, I think there's 3 questions on rent. I might deal with that, and you might take Michael's question, and we might end it at that point. So the rent questions are all very similar. The rent exclusion is effective for R&D claims covering year 2020 onwards, and not year 2019 being claimed in 2020 was the question. Or the rent exclusion, does this include rent of a commercial dryer? What I would say to you is the rent, the guidance issued 1 July, and it's very possible that the revenue might seek to argue that any claim after 1 July that includes rent should be examined, and is it appropriate to claim rent? They could make that argument. I don't know, they haven't made any arguments to us yet on rent, and we have to see what happens with TALC on Thursday. But I would be firmly of the view that a 2019 claim, the company decided to invest based on an incentive that the state made available. That decision was made in 2018, and rent was allowable for the year ahead, 2019, and the guidance didn't say you couldn't claim it. You made your investment decision with that in mind. So I would absolutely, and we're saying this to all our clients, include rent for the 2019 period. That's not to say that the revenue will seek to unsettle it, but I think there's a strong basis that you have a legitimate expectation when you were making the investment to claim that. On the dryer question, the guidance talks about a building or structure rather than hiring in a piece of equipment or plant. So I would draw a distinction between rent for a building and rent for a piece of kit. So again, and I'm not offering advice to you, but I would be of the view, if it was my dryer and I hired it or rented it, I'd claim it. I think the guidance is to do with buildings. And I might hand over to Damien, and then we'll close it out after this last question.
We have a question about if you have expenditure that would normally be deductible in another EU country, can you voluntarily forgo the deduction in that other country in order to qualify for the Irish R&D tax credit? The legislation talks about expenditure being available for a deduction in another country, and if it is available for a deduction in another jurisdiction, then the tax credit can't be claimed in Ireland. So I'll not comment on the specifics of the case, but certainly the legislation is clear that if it's available for that deduction, then that's enough to put you out of the tax credit. But happy to discuss that question or any more offline as appropriate. That's all the questions we have in, folks. So we might wrap it up with that, and just to thank everyone for their time today. Hope you all got something from the seminar, and we're very happy to have any follow-ups afterwards.